taxation on superannuation above $3 million for unrealized gains. On the face of it, sounds ludicrous, but when you actually look under the hood and take a look at some of the context and some of the detail, it actually may end up being a really good solution to a really major housing crisis in Australia. Well, look, there's a proposal at the moment, and it looks like it's going to go ahead by the current government, that will impose a tax on unrealized gains for superannuation above a certain limit. And so an unrealized gain is a gain that you haven't yet made. So for example, if you put $10,000 into the stock market and it jumps up 50%, so you've now got $15,000, which is $5,000 above your initial investment, then an unrealized gain would be that $5,000, assuming you haven't sold that investment yet. So the current government is planning to tax that $5,000 even though you haven't actually made that return on your money in superannuation. Now, there's a few layers to this, and I want to discuss this because it's a really, really important proposal. Taxing unrealized gains, on the face of it, sounds ludicrous, and we've actually, here at Money Media, we've actually made a video in the past talking about taxing unrealized gains when it relates to taxing the super and ultra wealthy, and how it actually doesn't make sense. And it doesn't really. It's preposterous. It's ludicrous when a government starts talking about taxing unrealized gains, because as you could imagine, you wouldn't be given a tax credit if you were to have an unrealized loss. So how would you be taxed on an unrealized gain? But there's a few parts to this, and context is a major factor. So in Australia, and if you're an Australian, you would well be aware of this, but in Australia we have a bit of a housing crisis at the moment, and essentially what we have is a massive shortage in supply of residential property, therefore driving the price of residential property up significantly and also pushing up rents as well. The interesting thing to know with superannuation in Australia is that we currently have held in private self-managed super funds in Australia close to $60 billion worth of residential real estate. And that's not even including the $110 billion we have locked up in these similar self-managed super fund accounts. And so, as you can imagine, we have very significant hoards of assets being locked up in superannuation funds. And so what the government are proposing to do is adding a tax on the unrealized gains on all assets in superannuation funds beyond $3 million. And so what they're trying to target here is they're trying to target asset hoarding by self-managed super funds, which are not owned by mum and dad who've been working in factories and cafes. What they are trying to target is that segment of the market that have significant amounts of wealth locked up in assets awaiting their retirement that are not really necessary. And so what this would do would be to encourage a significant sell-off of these assets within Australia from these self-managed super funds once this tax comes into place, which is proposed to be the 1st of July, which is a little over 5 weeks now. And so what this will do is add a lot of housing stock back to the housing market, which will increase the supply in Australia, which will naturally put pressure on prices to come down, which is exactly what Australians are after anyway. So a tax on unrealized gains in superannuation above $3 million, although initially on the face of it sounds ludicrous, there's actually a lot of merit to it. And if you are concerned about the housing crisis and you are on the wrong end of this housing market, then it's something that you should actually be in favour for. There's another important thing as well which nobody is talking about, and it's the purpose of superannuation itself. So when superannuation was first rolled out, it was designed to take the burden off the state for when the population was aging, and so less pensions would have to be paid out by the state. It wasn't designed to be a vehicle of wealth. And currently, by those who have significant amounts of wealth, it is designed as a vehicle to accrue long-term wealth and reduce tax burden. And so what you'll find commonly within self-managed super funds of those with significant wealth is they portion a lot of their income into superannuation, which reduces their tax for that year. And then once it hits the superannuation fund, what they're doing is investing in asset classes that are very long term. And in lots of cases, this might be things like land banking, where large parcels of land are purchased and held for significant amounts of time. What this does is reduces the supply of residential land to the Australian market, therefore increasing the rest of the supply, therefore increasing the price by reducing the supply. So there's land banking, and there's also residential properties, which we've just spoken about, which holds a lot of the residential properties away from the market. Now, some of these residential properties may be rented out, tenanted, but what we do know in Australia is that quite a significant portion of residential properties aren't actually tenanted out. What the government's trying to do is free up some of these residential properties, free up some of this residential land as well that's yet to be developed, to get the housing market going again, to make it a little bit more affordable, a little bit more competitive, strip down or incentivize those who are a little bit older from accruing all the assets and hoarding all the assets in the superannuation fund and waiting till they get a bit older to access it. What they're trying to do is stimulate the economy by adding assets back into the market.